Welcome to the WealthWise Show, your go-to podcast for all things financial education and wealth management education. I'm your host, the Wise Investor, and join me as we talk about all sorts of things from personal finance and different accounts and management techniques that you can implement in your financial decisions. My goal is to help you make wise financial decisions. So whether you're a seasoned investor or just starting your financial journey, this show is going to be tailored to empower you to achieve your financial goals. So get ready to unlock the secrets to building all sorts of things financial related. So let's get into today's episode. But before that, we do have a quick disclaimer that this show and all this information is for educational purposes only. Any topics, any companies, not just companies, but software that help you manage money or anything like that. None of that is endorsed unless stated. No sponsored unless it's stated. And we're not making no recommendations. I do not give advice over the internet. And please consult your financial advisors, money managers, and if you don't have one, please get one. Please do not get your financial information or advice from the internet. You can go to this government associated website, Broker Checker. It is made by FINRA. What is a self-regulatory organization, and on that website you can search up anyone you're trying to listen to for advice, and if their name is there, that means they're licensed to give advice. If they're not on that website or on the SEC website, which is similar to the Broker Checker, then they're not financial advisors, and you should think about whether or not this is going to be beneficial for your financial future. So that's just our disclaimer, guys. Like I said, educational purposes only, not giving advice. Please don't act on anything I say because it's not advice, not recommendations, and so forth. Enjoy the show. All right, guys. So today's episode, I really want to talk about something that is going to be useful for those who are a little more hands-on in their portfolios, those who are a little more active in making sure that they are basically on top of their investment. So this is really geared towards, well, if you're listening to this podcast, you might be hands-on. I would say maybe 90% chance that most of my listeners are hands-on. But I want to talk about something that is considered a form of using your equity or your stock shares. And actually, before I forget, guys, remember, this is for educational purposes only. Now, I don't offer advice over the internet because I don't know your personal circumstances. So this is not personalized advice. This is just a general idea or educational topics that you can use in your personal life, or you can take to your fiduciaries or financial advisors. So just keep that in mind, guys. Don't act on anything I'm saying unless you have done the research and you talk or you talk to a financial professional. So I was saying that with equities, with stocks, you can actually use your shares to produce income. And you might say, well, the wise investor, well, of course, dividends, duh. And you are correct. That is a form of income using your shares, because by owning the shares, the underlying asset pays you dividends. But I'm talking about something else. Now, back in 2020, in 2021, actually since 2020, I should say, there has been a phenomenon when it comes to options, and I'm talking about in particular stock options. So I'm not sure if I've done an episode on this. This is 13 episodes deep. So I have to go back through my library and see if I've done an episode on options. If I haven't, I will do one relatively not soon, but relatively. So basically using options for as a form of income. And you might be thinking, well, here we go. Here's one of those guys who are selling a how to make $20,000 a month with no education, no financial background or anything, and we're using options. No, that's not what I'm saying at all. Because as a fiduciary, that would be terrible advice. And of course, I don't give advice on the internet. So I wouldn't be doing that neither. But you can use options, not buying the options, but writing the option contract. So let me talk about a little bit about what are options. So basically, options are contracts that you and the potential buyer or seller make, saying, hey, I want to sell or buy, 100 shares of whatever the asset is at this price at this date. And when this date comes up, if the shares, are, available, I'm going to sell them to you, or I'm going to buy them. So there's two types of option contracts. You got call options and you got put options. So call options, when you're the writer of a call option, you typically own the shares that you are trying to sell at a certain price on a certain date. And that's typical. And then for locking in that contract, the person who buys that contract pays you that premium that they use to buy that contract. So, and the opposite is the same way. So if you have a put contract, you're saying like, hey, I'm willing to sell you these shares at this price on this date. And the person who buys that contract says, okay, you're basically giving them the option to buy your shares from them. But in order to buy that contract from you, they have to pay the premium, which it goes to you. You keep. And one of the things about, writing options is a lot of people don't understand how to actually use that. Some people do what is called naked calls or cash secure puts. And what that means is they don't actually have the shares to do a deal like that, but they have the cash. So cash secure puts is saying like, hey, I don't have the shares for you to buy, but I have the cash for the amount of shares that is required. And then if I get exercised, if you exercise, say, hey, I want my shares, then the transaction would happen that way. That's a little more safe because it's secure by cash, but are a little bit more, I would say, let me back up a little bit from this mic. It's a little bit more, not a little bit more, a lot more riskier. So when you are writing, naked calls, for example, you don't actually have the shares. You don't have a position. You're just, writing the contract and selling it. So you're pretty much at risk for whatever the price is when the person comes to collect. And that can be a potential unlimited loss. So that's the thing about writing naked options without having the other side, because like I said, you can lead to some severe damages to your portfolio, mental health, and family life. Trust me, no one wants that. So when you're thinking about using this strategy that I'm about to teach, which it's a simple strategy, understand that this is not I would say, a strategy to get you rich. It's not a strategy to replace your income for your job. It's not a strategy to, provide a living. This is just a hedge strategy. And I've talked about hedging before, is where let's say there's a downturn that's coming up and your portfolio is taking on some drawdown, meaning prices is going down. Well, this strategy could kind of help lessen that drawdown a bit so you can stay in the game. So one of the ways that I personally have used, you know, call writing or cover calls is, I own, let's say I own a low expense ETF with one of the indexes, and that low expense ETF is only like, a couple of dollars a share, not a couple of dollars, but let's say $40 a share. And to write a option, you have to have at least 100 shares of the company or the asset that you're trying to write the option on. So let's say I have 100 shares of this index ETF, and I understand, like, hey man, the market has been really hot lately, and I want to protect, some of the gains that I've gotten over this run. So what am I going to do? Well, very simply, when I would do this, my broker at the time was E-Trade. I'm not endorsing E-Trade. I'm not saying use them. I'm just saying what my broker was at the time was E-Trade, and they had a very simple, way to sell options. And so I'm going off of that, but it was very simple. I had 100 shares. I understand there was a time coming in, so I would make the order for, like, I'm trying to buy an option, but instead of buying, I would sell. And because I am selling the option, I am writing the option. And typically when you write options, especially on high volume assets like an index or something like that, you don't have to worry about someone trying to buy it. Someone's going to buy it. But yes, and the premium that I set usually, makes sense. So you can set the premium to wherever you want, but it has to make sense. So if you say, hey, I want to sell this cover call for $1,000, but the same contract, typically the premium is $100, no one's going to buy that. So, of course, make it reasonable price. And it will go out and I will get the premium. Now you might say, well, okay, so you got the premium, but since you sold something and it's a contract, what happens? So if I know that we are overextended, I'm going to use a simple indicator. Like, I don't use typical indicators. I usually just use price action for my chart reading. But let's just say the RSI. Let's say the RSI is high on the index I'm looking at and I'm using like a daily chart. And the RSI is high, and I say, hey man, we're really running hot, and I feel like, we might only got another 20 points on the index that, I have this ETF in. Then what I'm going to do is I'm going to sell the option contract for, let's say, at the end of the month. I would sell the end of the month contract for X amount of dollars at a, around, I would say $25 higher than where the current stock price is. So I know that might sound a little confusing because it's a little confusing to me. Let me kind of streamline that a little bit more. I have 100 shares of an index ETF. I go and sell one contract using my 100 shares, and I sell it at typically the ask if we're still going up, but if we're starting to come down, I'll sell at the bid. And what I would do there is, if let's say I feel like we're overextended, the RSI is high, and there's another 20 points of movement, I would find the contract for a month later, and if I know I want to sell at this particular price at this date, so I got the date, now the price. So if I know that another 20 points might happen, I will go up maybe 25 points. Because the point is not to get exercise, but to get the premium. And the reason being is, if I do get exercise, that's still not terrible because I just got 25 more points on my shares. And that is spoilers. That's coming up. So I would, sell that particular option contract. And so covered calls are a great way to, like I said, get that income in from the premium. And your hopes is the contract expires worthless. Now, how does the contract expire worthless? So let's say a month passed and we only went up 10 points and we're nowhere near the share price that I sold the contract for. All right. Nowhere near that price. Well, guess what? There's no deal. Because I said that I will sell you these shares at this price on this day, and it's not at that price. So therefore, we both meet our obligations, and the person who bought the contract basically lost their money. The contract goes to zero, and I keep the premium and my shares. Now, what if the price goes up to $30 a share? Well, simple. At that time, I'm obligated because I'm the person who sold the contract. Well, here's my shares for this price, which is 25 more points higher than, originally after we had this great run. And I sell them the shares for 25 more points and keep the premium. So if you have the shares, if you actually are the call writer, and this is your cover call, and you understand that, hey, we're a little high right now. I got in on this run and I'm already up, 25 points. I feel like another 25 points may happen. So that's 50 points. So let me sell some calls to protect my gains. How are you protecting your gains? Well, it's simple. If we start to pull back before we get to that price target that I originally had, then that income that is coming in from that premium from the contract that I sold, I get to keep that. That's income. And when we start to go down, I can use that premium to buy more shares. Boom. That's step one. All right. That's option one. All right. Well, what if it goes higher than the stated share price? That's fine too for me, because I understand that, hey, we're probably going to pull back. So go ahead and buy my shares 25 more points up. And when we have a pullback, I use the profit from the shares and the premium to get back in. Now, that is not ideal for everybody because your cost basis, is going to be a little wacky. And this is, like I said, for people who are really active in their portfolios, not people who are passive or just want their fiduciaries or their money managers to handle it, but someone who's a little more hands-on. So cover call writing is a great way to produce, some income when the market is starting to go in a turn down, because, like I said, one, you get the premium. So you get the premium from selling the calls, and if the market goes down, you keep the premium at, if the contract expires worthless. Two, if the contract don't expire worthless, you still get to keep the premium, but you sell your shares at a higher price anyway. So, if you want those particular shares, then don't write calls on them, because there's a chance that you might lose them if the market continues going up. But if it's, let's say, you bought some shares, let's say $40 a share, and you have 500 shares. So instead of writing calls on all 500, maybe write calls on 100 shares or 200 shares. Just write 1 to 2 contracts. That way, when the market is going down, you are not just sitting there in drawdown. You're defending your hard-earned money. One of the things that I like to tell people is, especially when I was an active trader, I fought for my money every day, because when the market wasn't doing what I wanted to do, I was deploying every strategy, every thought process I had to hedge and keep every dollar in my pocket. And if you're one of those people who are active, this is a great tool to use to make sure you are protecting your gains, you're not just sitting there in drawdown. Because that's one of the things I hate, where people, have, let's say, all this money, and they've made, like, especially from 2020, they made all this money in the market, and they just watch it dwindle away. And though some people can handle that, a lot of people cannot. And if you can't handle it, well, guess what? You're going to have to pull out some strategies to defend your portfolio. And one of these strategies is to cover call options, or cover call option writing. So those are the key points. Please do some more research in cover calls. This is a short little audio podcast episode to kind of get you in that framework. And do your research. YouTube, Google's, they're your best friend. And like I said, this is for education purpose only. I'm not your financial advisor. Unless I am, then talk to me outside of, I don't know. It'd be weird if you're talking to me now because I'm an audio. I mean, I'm a person, but I'm not there with you. So if you're talking to me, you're not talking to me. You're talking to a podcast, and that's weird. So talk to your therapist and talk to me when you're ready to ask those questions. But speak to your speak to your financial advisors, your financial professionals before you start to implement this strategy. So don't do it just off of a 20-minute podcast episode. Do it when you have talking to someone and it makes sense, you studied it, and you see how it works. Because even though it's simple, if you've never done it before, it can be complicated. So if you're more active, you more likely may know about options. But if you don't, go ahead and talk to your advisors about it. And if you're not active and you have a money manager, talk to them about it anyway and say, hey, is there a way when the market is, going through a downturn, can we implement strategies to hedge my portfolio? That way, I'm just not sitting in drawdown. Talk to them about that and see if they can come up with some strategies, and maybe even mention, hey, maybe we can do some cover calls and see what they say. So I hope that made sense. It made sense to me, but sometimes I always don't make sense even to me. So I hope you guys enjoyed this episode 13. So that's nice. Of the WealthWise Show. I usually have a catchphrase, but I forgot it like 10 episodes ago. So I'm just gonna do this new one. Well, it's not a new one. It's the same one I've been doing. It's just me just saying stay WealthWise. So until next time, guys, stay WealthWise. Investment advisory and financial planning services offered through Simplicity Wealth and SEC Registered Investment Advisor. Sub-advisory services are provided by Simplicity Solutions, LLC, a registered investment advisor. Any insurance, consulting, and education services offered through the WealthWise Show. The WealthWise Show is not affiliated with Simplicity Wealth and Simplicity Solutions.